This is the Friday, August 25th, 2017 version of the Market Plus segment. Joining us now, Darin Newsom. Darin, hello.
Hi, Paul.
Glad to have you here.
Yeah.
We teased it a little bit in the program, twice. Harvey is, we're talking feet of rain, 3-4 feet in an area that is very fertile. We're talking cotton. Matt in Nebraska, he asked, how will Harvey hitting the South affect the markets? He's talking crops, he's talking exports, he's talking oil. How is what Harvey is going to do, because we're about ready to harvest cotton.
Yeah.
What's it going to do to the cotton market?
Well, it should have a lot of impact in a number of different markets. Number one, we're already shutting down refineries or clearing out that area. We saw 12 years ago with Katrina, when it took a direct hit on New Orleans, what happened to the export system and the entire river market system. Shouldn't be that bad this time, but I do think it's going to impact, as we're trying to get all this grain to, all this old crop grain into storage. All of a sudden, not only is that going to weaken basis, but if we can't use some of the southern ports, that's going to cause some problems. But then we've got the cotton market, and it's far enough along. I mean, if we see this horrific flooding like what they're forecasting right now, I think it could be very damaging, because we're already in a relatively tight supply and demand situation for cotton. And if we see this sort of problem develop, and I'm pretty sure that it's going to happen at least in some areas, I think that's going to help push this market a little higher. We've seen some buying recently come into the cotton market. We've got good action in the spreads. I think this is really going to be the next thing to push the market even higher.
Because if you have those bales or those modules that are sitting out in the field, they're not going to be able to sustain. Even if it's up out of the field, how is that going to sustain 2 feet of rain?
Yeah, it's not going to. So, I mean, we might have seen a little, I can't remember if we saw a little bit of selling on Friday, but by and large, I like the action that we've seen in the market. It looks like everyone's getting ready for this market to start taking off here over the next couple of weeks.
All right, Matthew, thank you very much for your question. We have plenty others, and you can always tweet at us at Market to Market. You can also go to our Facebook page, IPTV Market, or even Instagram if you want to leave a question. Kent, though, emailed us at markettomarket@iptv.org. I'll get the address right. He asks about weather. What does a September 15th frost, below 30 degrees, from I-80 North do to the markets? Anything's possible, Darin.
Oh, yeah, anything's possible. And if we look at the type of weather that we've had, I mean, we had a wet spring, had a dry summer. What's the likelihood that we could go into a wet fall as we're trying to harvest these grains? And then let's throw on top of that the possibility of an early freeze. And we have seen some cooler temperatures. Maybe that would be enough to finally have some sort of weather event actually get the market's attention. But as we've talked about, and I believe we talked about in the program, until traders get the official notice that there is a problem, I think it's going to be hard to get the investment side interested in this. We will see the spreads react, and if the spreads react strong enough, then the market itself, the futures market itself, will start to come up as well.
And really, an early frost is about the only thing left that could happen. We've made it through pollination. We've made it through the key time in August for soybeans. It is cooler in a lot of the country in August. That doesn't necessarily mean a long-term trend of an early frost.
No, it doesn't. I mean, I haven't seen any data as to what's the probability of an early frost happening in the northern tier of states or in the northern growing area. But I mean, as you said, anything's possible with the weather, and this year certainly seems to be living proof of that.
Well, it's always cold in Canada.
Yeah.
And Phil in Dresden in Ontario, Canada, he always likes to, good friend of yours, good friend of the programs. He has a couple of questions. Actually, he had 4 great ones. Thank you, Phil. Phil first asks, I'm going to do this one. I want to talk, he asked one about USDA report. We'll cover that in something else in a podcast coming up. But he asked, copper recently had a 14-month high. Now, we know that he's asking if that's a litmus test for the global economy. But is it relevant to grains? We know that copper is indicative of maybe building. That's one of the reasons we report it. But is it relevant for grains as an indicator of future demand?
In a way, it could actually be looked at that, because copper is kind of the global economic indicator. If we want to look at some of the commodities that are out there, gold has its run, but it's a precious metal. Crude oil is just too psychotic to really pin anything on. But copper's sitting out there as an industrial metal, and when we see it move up, and as Phil pointed out, up to a 14-month high, usually if you can get a 4-month high, that's usually the sign that the trend has changed. So what it looks like here is we do have a bottom that's been established in the copper market. It's starting to move up. If global economies are actually getting better, it's possible demand could strengthen as well. But we have to look at this. Where are the supplies going to come from to meet that demand? And then it comes down to a currency game. It comes down to trade disputes. It comes down to a lot of different factors at that point. Who is going to fill that demand? But yes, if the economies are better, it could certainly increase global demand. But with everyone seemingly having enough supplies, who's going to fill that demand?
Okay. You neglected one thing. You didn't say hi to Phil. You need to say hello.
Hi, Phil.
There you go. All right. So Phil also asked, though, bearish sentiment in the grain market seems overwhelming now. We talk about the butterfly effect. Mm-hmm. Where is the butterfly fluttering? Are there bulls anywhere?
If I could say that I see a bull out there somewhere, then it wouldn't necessarily be the butterfly effect. It wouldn't be chaos theory if we could actually see it. But something certainly could happen. I mean, we talked about in the program where it was in August last year, in 2016, that we put the low in the corn and soybean markets. Where did it come from? It just came out of nowhere. We still had record crops. So, there could come a reason, there could become a reason why we put a low in the markets. Because he's absolutely right. We've got incredible bearish sentiment. We've got sharply oversold markets everywhere you look in agriculture. Maybe it's Harvey. I would see that more as a bearish factor in some of the grains, but something's out there that could possibly bring the buyers back. I just don't know what it is right now.
That's always that inherent risk that we talk about in trading, because what you think is one thing ends up being another, and you're caught long or you're caught short. I mean, it's a risky, trading commodities, as we always say, is a risky gambit.
Absolutely, which is why, it's really impossible to make outlooks and these sorts of things, because you don't know what that unexpected piece of news is going to be that changes everything. And they happen all the time. You go to war, something happens here, weather event happens there. They happen all the time. They can change the direction of whatever market we may be looking at.
All right. Phil, thank you for those questions. Dan in Prairie City, Iowa, though, he wants to talk about, you mentioned reports just a little bit. Dan wants to know what national corn yield and national soybean yield is being priced or traded in the markets right now. He doesn't think, if it's not 169 and 49, then what?
It's whatever USDA last said it was, because that's the system that we have. We can have a lot of crop tours go out, and that's great. They provide information. I was just part of one. I didn't actually do the tour, but I was with a group in Illinois this week that did their own tour. And then there's lots of them out there. They can provide all this information, but the market is trading what it's been told to trade. That's the system that we've allowed to develop. And that was the August USDA numbers. The next set of numbers will be the September numbers, just from USDA. Those are the numbers. Those are the yield numbers that are in the market right now.
And that's what the chart is that you see there on the screen, is just how, once we got that report, it has been down. And that is something that Darin and I go over in an upcoming MTOM podcast where we discuss some of those reports. So you'll have to keep an eye out on our Twitter feed for when that pops out. We have other questions, and this one has more of a global reach, Darin. Roger is asking about a couple of things. This week, or in fact, I think it was just yesterday, Brazil said, hey, you know what, United States, any ethanol you're sending here, we're going to slap a 20% tariff on. We've had great exports of ethanol to Brazil. But Roger's question is about exports. He says more exports and feed use won't fix corn prices. E15 in every gas pump can. Why don't we work on new ideas like E15 instead? If it's been good for us at E10, why not E15?
Number one, the energy lobby is never going to allow it to happen. So E15 is a nice debate, but I just don't see it happening anytime soon. There's another way that I've talked about frequently as to fixing the corn market, and that is to not plant as many acres. Now, of course, the answer to that is, well, then what do we plant?
Out of Dodge.
I know
that.
I know that. I understand that. But I mean, when we consistently plant 90 million acres plus, and Mother Nature either cooperates or not, this year she didn't cooperate, and we're still looking at one of the 5 largest production numbers, possibly on the books. How do we fix the corn market? We reduce our supplies. We reduce the amount that we produce. I really don't know any other way. We can try to create new demand, but legislating more demand is always a problem because that legislation can go away. We have to not produce so much that we continue to add to our supplies every year and put us into the situation where we have to try to create new demand. Sometimes it just doesn't happen.
Well, and the current administration has been saying maybe we don't need the supports we have now for renewable fuels. And so we might be looking at that, but it doesn't seem to be impacting some of the exports, at least to Brazil. We've had a pretty good year in that. We have. You know, that is a threat. I mean, does something happen to the renewable fuels program? I mean, with the new renewable fuel standards, can that be changed? Sure it can. I mean, so can anything. So can anything. Yeah. All right, our final question here before we finish with a commodity question of the week. Jeremy in Lanark, Illinois, he's saying that the LC charts, we're going to talk some livestock here to close, they've been beat up. What is your 3-month outlook? We talk near term, but let's talk about May-June outlook for livestock here. Better times ahead with calves being pulled off the grass early? Yeah, you know, again, I'm more of a technical analyst than a diehard livestock fundamentalist, but I like the look, you know, if we look at the 3-month, I like the look of the December contract. I think it's coming down to support. I think it's going to find some buying. It would be nice to see it start from the commercial side, much like we talked about in hogs during the program. But I think I like the way the December contract's looking right now as far as buying opportunity goes. And then if I look at the market as a whole on its long-term monthly chart, again, I still see both live cattle and feeder cattle in uptrends. So if I'm looking out into next spring and even next summer, I still think the market's got some potential. We could be getting close to that low in the cattle market, particularly if we're looking out at the December contract. Could be some opportunities in here. Hope. We're ending it with hope. How about that? All right. Now, Darin, before we leave you, we have to get to our commodity question of the week. We are nearing the end of our stockpile of our student questions, and we're looking for a lot of help, thanks to the folks at Iowa State. But now it's over to you. Does anyone in the agricultural markets and risk management track at the University of Minnesota have a question for our analysts? How about you at Michigan State or Indian Hills Community College? Send us an email at markettomarket@iptv.org, and we can talk about getting your video to us, or you can send us a direct message on Twitter, and we can talk about things here. But this is our final question here from Cody.
In the future, do you think all farmers are going to have either 2- or 4-year degrees?
Yeah, I do. I think we're moving in that direction. You know, we're seeing a lot more we're seeing the younger generation of farmers coming through college, learning more about different aspects of the business end of it. So yes, I do think so here in the next 5-10 years, certainly that we're going to see a larger percentage of farmers with their 2- or 4-year degrees. Because you could spend a lot of time, even if you just do 2 years, and you spend 1 year on learning marketing and understanding the markets for trading for futures. Good luck. You know, good luck. You can get that done in a year. And then the other side of learning the genetics and the traits and you know, applications of things. Boy, that's an intense 2 years, even if you do it that way. You know, you study the science behind it. You stay up on the science. You know, you get a good foothold in that. You get a good foothold on the business end of it. Yeah, I think it's going to be a benefit for all of these agricultural colleges that are out there offering the 2- and 4-year programs. I think we are going to see it, and I think it's going to continue to grow. Fantastic. Darin Newsom, thank you so very much. Thank you, Paul. Good to have you here, and join us again next week when Sue Martin will sit across from Mike at the Market to Market table, and the two of them will explore the pricing challenges of a key ingredient in a growing market. So until then, thanks for watching or listening or reading. I'm Paul Yeager. Have a great week.